Just a minute. Yeah, can you make me the host so that I can share the screen? Oh. I'm still not able to.
Yeah, sir, you are host now. It is showing.
Yeah, yeah. Sorry, I joined from two devices. That's all.
Okay.
Okay. I think everybody is able to see the screen, right?
Yes, sir.
Right. Okay. So I just thought that the best way to begin is to just take up a few practical cases, right? And my request is to make it as interactive as possible. I actually want you guys to learn these strategies, and these are the strategies that can actually be applied. It's not a theoretical division. It's not a theoretical subject. This is very much practical subject where we try to optimize the tax and look at the other regulatory aspects generally for making a deal go through, right? So as I have displayed, it's a case of a company having three divisions, right? So company have given through a normal line, and dotted line represents divisions. So there's a company A, and there are three divisions: steel, engineering goods, recycling business, right? The engineering goods division is to be sold. So how can this sale transaction happen? Can anybody share some views on that? So the intention is that the company A wants to sell its engineering division to another company, right? So you can just probably mention in the chat box, whatever your views are, you don't have to worry on getting it wrong. How can this sale take place? Just a simple question. How can this sale happen? And XYZ are the shareholders of the. Okay, perfect, excellent. One is demerger. Anything else? Something very straightforward. So demerger is a good question. Slump sale, right? So that's the easiest way to look at it, right? So it's a normal slump sale, right? So let's right now focus on slump sale. Open offer will come for a listed company. XYZ situations are there, but right now my suggestion is let's look at slump sale because that's the easiest way of going for a transaction. Slump sale is a tax terminology. It's not a commercial terminology. So commercially, this is known as a BTA, a business transfer agreement, right? You transfer the business from one company, from one entity to another entity. So that's a business transfer agreement, which is required. Right. So merger. So all I would say all are correct answers. I'm very happy that I'm getting these answers. Selling all assets, all these are the correct answers. So in fact, as you can see, there are multiple ways of doing a same transaction, right? So the way of going about it is which is the best from a tax perspective, which is best from a stamp duty perspective, from FEMA perspective, from SEBI perspective, etc., etc. So we are going to look at a few simple examples. So let's talk about BTA. So now, can anybody tell me what are the tax implications of a BTA, business transfer agreement, whether you call it a slump sale or you call it an asset sale, right? We are not talking about demerger, merger, because that's a separate NCLT process. We are right now talking about either sale of assets or sale of business. So any tries for that? What is the tax implication of sale of a business? Capital gains, perfect. So let's look at long-term capital gains, assuming that the undertaking is more than 3 years old, right? So long-term capital gains, we are talking about a tax rate of around 23%, right? So it's a company, so the surcharge is 10%. So let's look at 23% approximately. This is a capital gains tax, right? Assuming it's a long-term capital gains. Anything else? Do you think there's any other tax implication in this case? I've put in an arrow, so that's a hint for you. So one is a capital gains tax. Is there anything else that will be relevant here. Yeah, sorry, I got disconnected. I hope you can hear me now.
Yes, sir, you are audible.
Yeah, sorry. So Arpan, can you again make me a host?
Sure, sir. Sure, sir.
Okay. Hope the screen is visible.
Yes, sir.
Sir.
Okay. So as we discussed, one is a capital gains tax, and other is because the money is going to come to the company. So there is going to be a dividend tax, right? So dividend tax. Any idea what the dividend tax rate is? Anyone wants to attempt to tell me what the dividend tax is? Excellent, 35.88%. That's great. So perfect. I have such a precise answer, but very high. Generally, it's a so dividend tax is taxable at the slab rate, which is 30. Highest tax is 30%. Plus, there's a 4% surcharge, and there's a 4% education cess, and there's a surcharge, which is a maximum surcharge of 15%. 37% is the surcharge applicable for normal income, but for dividend and capital gains, the max surcharge is 15%. So that brings the MMR, the maximum marginal rate, to be 35.88%. Right. So you can see that the overall the transaction is taxed at a very high rate, right? 23% plus 35.88%. So are there any ways you can think of to minimize this tax? Any thoughts? So I think you already answered it earlier. Okay. Next options, I just want to discuss a few. So in emirate regulatory and tax optimization strategies, it's not one size fits all. So this is a slump sale that we talked about, or an asset sale, where we are saying the tax rate is 23% plus 35.88%. But the counter argument may be that what if it's a loss-making strategy? It's a loss-making division, right? In case of a loss-making division, the way the slump sale or asset sale, let's talk about slump sale, right? The way the tax implication of slump sale will work is there's a sale consideration and then there's net worth. Okay? So what is the sale consideration is actually less than the net worth. In this case, the long-term capital gains will be 0. It will be actually a loss of minus 100. But what we are saying is that the capital gains tax will be 0. So therefore, the capital gains is completely eliminated. It's not going to be very common. It's going to be rare. But that is also a possibility that the capital gains becomes 0 if the division is a loss-making division or the value is not higher than the loss-making. Second, where the dividend is not supposed to be distributed. Like we discussed that there are 3 divisions, right? And we are selling one division, which is the engineering goods. So this gets sold off. Divisions are still there. So the money may be required for the steel and the recycling business, right? So they may not actually need to repatriate the money back to the shareholders, right? So when the requirement of repatriation is not there, you can actually save the dividend tax, right? You can actually save the dividend tax, and as we discussed, if there is no capital gains, then you can actually save the capital gains tax. So these are the counters where if these situations are there, slum sale may still be advantageous, but generally slum sale is not advantageous. And the tax burden is very high, right? So we go to another strategy. Can anybody suggest what can be other strategies? Reverse acquisition, anything else? The answers were already provided in these the demerger. Perfect, right? So we are looking at a possibility of demerger. So how would a sale happen through demerger? So again, this is the same structure. There's a company A. There are 3 divisions underneath the company A. Now instead of going for a sale of assets, sale of business, we go for a demerger. Right? So under demerger, which is exempt under 219AA, there are some conditions which are to be fulfilled for a demerger. So one of the conditions is that 75% of the shareholders in value of company A, that means let's say X, Y, Z, assuming that they are holding shares in the same proportion, right? So 75% of the shareholders in value of company A should become shareholders of the resulting company. This is the demerged company, company A. NewCo is the resulting company. So there is a transfer of engineering division to the new company, but the new company issues shares to the same shareholders, right? So this is not actually a sale. It's a simple demerger. It's a splitting up of one company into 2 divisions, right? It's not actually sale. So XYZ wants to sell off the assets, or company A wants to sell off the assets, but this is a demerger, so it doesn't actually satisfy the objective. So is there anything that I'm missing here? Can you put anything that you think I'm missing? Okay, so it's not just a minute. Right. So what happens is that there's a demerger that happens, and then after demerger, there's a sale of shares that happens. So because now there is company A and NewCo, right? So you simply need to sell the shares of the NewCo. Right? It may seem like a very simple strategy, a very obvious strategy, but just imagine the amount of tax that you're saving. The money goes to not the NewCo but XYZ. The money directly reaches XYZ. So as we discussed in the earlier strategy, the tax rate was 35.88% dividend tax, second 23% capital gains tax. So can you think about what is the tax in this case? Demerger plus sale of shares. The resulting company should be India. Perfect. Excellent. I'm assuming that all the other conditions of 219AA are getting satisfied. So that's the assumption that I'm making. Okay, so demerger, first we did demerger, which is a transaction which is exempt, right? So this is an exempt transaction. So demerger itself is exempt, and the only taxable transaction is sale of shares, right? Sale of shares transaction, which is taxed at 20% long-term capital gains tax, right? Plus the surcharge and cess, right? So surcharge would be maximum again 15% surcharge is there, and cess of 4%. So this would again give you a tax rate of around 23.5%, right? So the entire 35.88% dividend tax is completely exempt in this transaction. So simply breaking down the simple transaction of sale of business and repatriation through dividend, we are breaking it down into two transactions. One is demerger and then sale of shares of the new co. So by doing this, you are eliminating the dividend tax. Right. So this is an important strategy. If you have any questions till this point, just let me know. We can address those questions and then move on. LTCG of 23%, excellent. No tax or transfer is exempted. So no tax for demerger, but long-term capital gains will be taxed. Right, excellent. So you have got the right answer. Any questions till now? Okay. As you know that, of course, benefit of 54F also will be available because these are individual shareholders. Assuming these are individual shareholders, if they are not individual shareholders, then 54 EC or something. But predominantly, we are eliminating the dividend tax of 35.88%. Right now, what can go wrong in this strategy? So one of the things that can actually go wrong is in case company A is actually a listed company. Right? In case company A is actually a listed entity, then what happens is that when you are splitting up the company into two, right? Company A and the new co. Company A is a listed company, so all the shareholders of company A would be allowed to sell the shares in the market, right? So now there's a new company and you are giving shares of a new company. So you ideally will need to list. It's not a compulsion, but ideally you would need to list, because in case it's a listed entity, so in case it's a normal unlisted entity, you will need 75% shareholders approval to carry out this demerger through the NCLT process. But in case it's a publicly listed entity, there's one more criteria which is relevant, and that criteria is you need 50% or more approval of the public shareholders, right? So public shareholders may not like this demerger. Why? Because in case of demerger, you are giving them shares of the unlisted entity, right? So one of the possibilities that you get company A also, the new company, you have to get it listed, right? Which is a possibility. It's actually sometimes it's a strategy used by companies. So Adani is very commonly known for using these strategies. Adani Enterprise is the flagship company and which got demerged multiple times. There's Adani Green. So many companies are there, Adani Transmission, etc. So they go for a backdoor deal, backdoor listing. This is known as a backdoor listing. I'm not going into that because that's a separate subject in itself. But I'm just saying that in case the company that we are looking at is a listed entity, there are some other complications that we have to consider. One of the possibilities that we may have to get the new company listed, right? There are certain advantages and disadvantages of getting the new company listed. So as I mentioned here, one of the advantages that the tax rate would be reduced, right? There's a possibility to reduce the tax rate because a listed company, the shares of a listed company are subject to tax at 10% plus surcharge cess instead of 20%, right? So 20% is not the tax rate, it's 10%. So you reduce your tax rate to that extent. There's a possibility of getting grandfathering benefit if the acquisition is as on 2018. You get the market value as on 2018, and the tax may be actually zero because of the grandfathering benefit. This is not something which is very straightforward. There are some conditions which are required under 55 to AC, right? So I'm not going into that, but overall what I'm trying to say is that there's a good possibility to reduce the tax rate if the new company is listed. One obvious disadvantage is that the procedures, the amount of procedures which are required is going to be much higher, right? You need to go for the listing process, you need to go for the NCLT process, etc. Right? But the most disadvantageous thing is the stake. In case of a demerger, you need to, and the demerger is to a listed entity. The listed entity has to give at least 25% stake to the public, and the buyer may be interested in a 100% stake. So because of these commercial reasons, this strategy may not work in case it's a listed entity. Right? One of the counter is simply demerging it to an existing company, a buyer company. Right? You can. So if company A is a listed entity, the division which is to be demerged can simply be hived off to a buyer company, right? Or directly a buyer company can take off this company, but the condition is that you need to still fulfill the conditions of demerger. Right? So let me, I just go in a bit. What I'm trying to say is that demerger can take place in a new company. We generally think of demerger as taking place in a new company. It is also possible to do a demerger in an existing company. Right? Even existing company can take over the resulting the demerge undertaking, but the existing company will need to issue shares to the shareholders of the demerged company. So here, if this is not a new company, it's an existing company. Existing company. In that case, existing company can issue shares to XYZ, right? Still, the thing is that XYZ still don't have an exit option because they have got shares of the existing company. So in that case, what can happen is, it's a very interesting strategy which has been recently done by Alembic, where Alembic demerged its undertaking to another unlisted company called Steno, right? So it's a very interesting structure where you can actually get a minor delisting, right? So you are actually delisting single undertaking. So what can happen is that the listed entity can demerge one of its undertaking to an existing company, and the existing company can issue equity. It's possible to issue equity. It's just that I, as a shareholder of a listed company, would not want equity of an unlisted entity. So you either give me a listed equity or you give me equity and immediately the promoters buy my equity, right? So that's a two-step process. It's a demerger. I'm getting an equity as a result of demerger, and the promoters immediately buy my equity. So that's a cash demerger, right? Technically, I'm still fulfilling 219AA, right? Because at the first place, I'm given equity shares, and then immediately the second transaction is that there's a cash for equity. Sorry. Okay, I just look at the questions. Sir, so here, in order to save tax, we shifted from slum sale to demerger. Correct. That's the correct answer. I mean, that's what we are trying to do. We are trying to optimize the tax. Okay. So as I mentioned, there can be equity which is immediately sold to the promoters. That's one of the possibility, and that's a very interesting scheme of Wipro in 2000. I think 2009 they did this scheme of arrangement where such kind of demerger was there. Equity of Wipro Enterprise, which is an unlisted company, was given, and that shares of Wipro Enterprise was immediately acquired by the promoters of Wipro. So therefore, effectively, the shareholders got cash as a result of demerger, right? So that's also pretty unique. You generally don't think of demerger as demerger for cash. You will think of demerger as demerger for share. But as a part of the NCLT process itself, there was a cash which was issued against the shares of the resulting unlisted entity. Okay? The other very interesting thing is RPS. So if you look at 219AA, one of the condition is that 75% of shareholders of, let's say, demerged company should become shareholders of resulting company. Right? This is the condition. They don't say whether you should become a equity shareholder or a preference shareholder. Right? You can be a preference shareholder. It can be RPS, compulsorily convertible preferences, anything. But let's go with RPS. The advantage of RPS is that RPS is kind of a debt. Right? So what happens is that in case I want to sell my undertaking, I have a company. Right? We are looking at company A. Now I have a company A, which has an engineering goods division. Let's say it's worth over 1,000 crores. So this 1,000 crores division is demerged to another company, let's say existing company, and against that the existing company issues RPS to the shareholders, which is XYZ. The advantage is because XYZ, let's say, says that I don't need the 1,000 crores today. Right? So XYZ gets RPS worth 1,000 crores. Right? So what they can do is they can redeem, let's say, 100 crores. They can redeem 100 crores and pay tax only on the 100 crores. 900 crores they can continue as shares in the existing company, and against this 900 crores they will keep on getting dividend. So out of the original structure where we were looking at a huge amount of tax, 23% plus 35.88%, then we eliminated 35.88%. Now we are saying that even for CGT, we can defer. It's not a case of eliminating tax, but we can defer the tax, right? So let's say I am redeeming only 10%. So effectively, I am paying tax of only 2.3%, right? So this is the tax optimization strategy that can be done. It of course needs to be backed up by the objectives that the promoters have. There are things that can go wrong in this case. You will need to see the buyer company's profile. If it's a huge buyer company, like let's say it's Reliance, right? You would not bother to hold the redeemable preference shares of Reliance. But let's say if it's a small company, not a very profitable company, having a very track record, you would want to take all the money today. You may end up paying more tax, but that's so be it. Okay, so any questions till now?
सर जो आप ये रिकॉर्डिंग कर रहे हो ये हमें प्रोवाइड होगी?
Yeah, I think Arpan should be the right person to mention.
Yes, it will be uploaded. Yes, it will be uploaded on our Vikasa's YouTube channel.
Okay. So I'm getting a question for explaining. Okay, so great. I'm getting good questions. So is it possible to unmute? Is that possible, Arpan? That the participants can unmute themselves and ask the
Yes, sir.
question.
Yes, sir.
Right, so I would just suggest, if you want, you can just go ahead and unmute yourself. Otherwise, I'll just take up the questions which are mentioned. Right. So one of the question is that, can I explain RPS once more? So the way we are doing it is, demerger is not actually a sale. Right? Demerger is simply splitting up the company into two parts. But what we want is actually a sale. We just a minute. Yeah. So what we want is actually, we want to sell the company, sell the division, right? So to sell the division, what we do is we demerge, and we demerge against RPS, because 219 actually provides me to even use RPS, right? So I can do a demerger, I can issue RPS. The advantage of RPS is that it doesn't give me voting rights in the new company. So the buyer company will not hesitate in giving RPS, because it's more like a default consideration. And it's redeemable preference shares. So by its very nature, redeemable preference shares don't have voting rights, but redeemable preference shares need to be redeemed at a set time in future. Is that clear? So it is like so instead of giving 1,000 crores today, that 1,000 crores is coming over a period of time. It will come over a period of, let's say, 1 year, 2 years, based on the redemption conditions. It can be deferred as long as, let's say, 10 years. Right? So all these options are there with a redeemable preference share. Okay. Equity scheme is a type of demerger and buyback. I don't understand what you mean by this. So buyback is a separate thing in itself. So not taking up. So what I'm talking about equity scheme. Yeah.
So I wanted to ask, just in the example that you gave for Wipro Enterprises, in
Right.
which the Wipro gave demerged shares of Wipro Enterprises, and then promoters bought it back quickly, and that bought back amount is not the buyback scheme type.
Okay, so bought back means, I was talking about there was an NCLT scheme itself. In the NCLT scheme, it was not immediately, it was on the same closing date. So let's say 1st April, I get the shares. I don't actually physically get the shares, but the scheme was that the shareholders get the shares, and immediately on 1st April itself, it is automatically bought by the promoters. So this is not buyback, this is sale of shares or purchase of shares. So
Okay,
because I'm talking about Wipro, not Wipro buying it back, but the promoters of Wipro. So promoters of Wipro will buy for cash. right? So this is kind of, very interestingly, this is a kind of demerger for cash transaction.
Okay, sir. Understood.
Okay. Any other questions? Okay, then I can go ahead with the. Can you throw some light on merger and demerger by loss-making startups? Are there any other strategies used by them to avoid taxes? For example, Blinkit is bought by Zomato while Zomato itself is in loss. So are you talking about 79? So I would not want to look at the startups right now, because startup itself is going to be a very different topic. It's a separate topic in itself, but I'll just give you some idea about what startups are looking at. So generally startup will not look at saving taxes, right? Because startups are not making money, so they would not be interested in saving taxes, or that's not the fundamental criteria for them. So what startups will be looking at is generally externalization, right? There's something known as externalization, where Flipkart, let's say, what Flipkart did it, you know that Flipkart is an Indian company, right? But it's actually owned by a Singapore company. So the head office of Flipkart, or the parent company of Flipkart, used to be a Singapore company. Same for PhonePe. A lot of Walmart owned companies have similar structure, right? So there are a lot of startups which would go for this. They would have a US parent company or a Singapore parent company. The advantage of this is that the investors can come in the US parent company, or investors can come in a Singapore parent company. The other advantage is that the other advantage is that the Singapore parent company or the US parent company can even go for a listing, right? So these are the advantages that startups would look at. The other advantage is that when Singapore or US parent company is used, there is no FEMA framework which is involved here, right? So FEMA is not applicable in this case. So that is the advantage that the startups would generally be looked at, which is known as externalization. Externalization means an Indian company would actually have a parent which is overseas parent entity. So this is a structuring that startups would use. Right. Anything else, or you want me to? These RPS are transferable? Generally not. RPS are not transferable unless it's listed. Right? So only listed RPS are transferable. Otherwise, RPS are not transferable. Okay, I'll just share the screen. Yeah, I hope it's visible. Okay, so right now we have looked at the we have looked at the sales strategies, right? Where we took one example where we are looking at strategies where a company having multiple divisions can sell its undertaking. There are some strategies known as repatriation strategies. So where repatriation is simply a case of company giving dividend to the shareholders. Right? So dividend, we call it dividend, but it can be anything else. It can be in whatever form that the company can bring money to the shareholders. Right? So as you are all aware, that dividend from a company is subject to tax. The highest tax rate is 35.88%, so which is pretty expensive. So the strategy is that how do you bring the money from the company to the shareholders at a much cheaper, in a tax optimized manner. Right? So one of the strategies that a company can be converted to LLP. The advantage of this strategy is that LLP, if LLP distributes, right, in case of LLP, it's known as partners, not shareholders. So on distribution of profits by an LLP to its partner, the tax rate is 0%. Right? Similar to a partnership, any distribution of profit by a partnership to its partners is tax free. Right? So that's the advantage of converting a company to an LLP. It may or may not work out, but at least it's a good option to understand and good option to keep in mind. We have seen big companies also looking at conversion to LLP. So this can be one of the very interesting strategy. One drawback of using this strategy is that in case of conversion of company to LLP, there's an exemption which is given. So exemption is given in section 47(13)(b), right? So this is a section that gives exemption. There are a few provisions in 47(13)(b), but the most important provision is the turnover of the company for the last 3 years has to be less than 60 lakhs. Right? If the turnover in any of these 3 previous years is more than 60 lakhs, in that case, the conversion will be taxable. Want to avoid that? There are a few ways to go about it to make it tax free. So one of the structure is I'm going into a few difficult territories, but in case you have any doubts, please message or just your mic, right? Otherwise, I'll just I'm going on with these strategies. So one of the strategy to do a tax-free conversion is that a company, let's say we talk about company A, right? Earlier example, company A having 3 divisions. We are talking about the engineering goods division. So the engineering goods division gets demerged to another company. And that new company, it's a new company. And the new company converts. So it's a 1,000 crore company, right? So we are issuing shares worth 1,000 crores. We have assets worth 1,000 crores, right? So do you think that 47(13)(b) will be satisfied if we convert the new company to an LLP? You can just let me know your views. So I'll again repeat the question. What I'm saying is that company A demerges to a new company, and new company issues shares worth 1,000 crores, and the new company immediately converts to LLP. So what are the implications under 47(13)(b)? Does it satisfy the tax-free conversion? Right? So the one of the criteria for tax-free conversion is in the last 3 years, the turnover should be less than 60 lakhs. Okay, so it's not an easy question. So the answer is that 47(13)(b) says turnover for last 3 years, right? So the key criteria is last 3 years. It's not the current year. So then what happens is that in, let's say FY in the current year, starting from April, right? Let's say we are talking about FY 24. So in FY 24, we go for a demerger. And in the same FY 24, the resulting entity is converted to a new company. Resulting company is converted to an LLP. Right? So the advantage is that the new company doesn't have, because it doesn't have any history, the turnover in the last 3 years is 0 because it doesn't exist. So therefore, this condition is satisfied. Right? 713(b) say that there is X, Y, Z condition, and you need to violate one condition. Either of the condition has violated in order to not fulfill 47(13)(b). But because you are a new company, you will not violate this condition. So therefore, this is a loophole which is there, and this is a loophole that can be considered. Instead of demerger, it can be merger into new companies. It can be gift of undertaking. A lot of other different ways where a company can be converted to an LLP tax-free, and then the LLP can distribute profits without paying any tax. Strategy is to simply use a buyback instead of dividend. Buyback is taxed under 115 QA. The tax rate is 20% plus surcharge cess, which is coming out to be around 23%. But the way the computation is that it's 23% on the distributed income. I'm going a bit fast. Let me know if you want me to elaborate on anything. Okay? The way 115 QA works is that it's 23% on the distributed income. So it's like you want to distribute 100, right? You will pay a tax of around 18.9, and you end up with somewhere around 81.1, right? So 18.9 upon 81.1 will be around 23.3% approximately, right? So effectively, you are paying a tax of 18.9% on the amount that you want to distribute, right? So this is a huge advantage. From 35.88%, you have reduced the tax to 18.89%. There, it's not very straightforward because there are a lot of conditions under Companies Act, under Income Tax Act. When you go for a sale of shares, are mentioned in 56.2.10, 56.2.7b in case of issue of shares. There's also 50CA, which is relevant in case of sale of shares. Fortunately, conditions don't apply. 56.2.10, 56.2.7b or 50CA, right? Because 56.2.10 applies when there is a receipt of shares. Right? Here, the company is not getting shares, the company is destroying the shares. So because it's a case of destruction of shares, 56.2.10 doesn't apply. 56.2.7b obviously applies for issuance of shares, and 50CA applies when there is a sale of shares, transfer of shares. So here actually it's a transfer of shares because it's an extinguishment. So buyback. So let's look at buyback. What happens in case of buyback? So there's again company A, there's XYZ shareholders are there. Let's say X wants to exit. One of the possibilities that X can simply sell the shares to Y and Z, right? When he sells the shares to Y and Z, all these implications are relevant. All these implications will come in picture. But instead of selling the shares, the company X can also buy back the shares of Mr. X. Right? When the shares are bought back, none of these conditions are applicable. And on top of that, the procedure is that the company is taking over the shares of Mr. X. So when this happens, there's a exemption under Section 10. Right? So under Section 10, the capital gains of Mr. X is exempted. So because the capital gains of Mr. X is exempted, there are no deeming provisions are anyways not relevant. The tax implications are on the company. As I mentioned, the company pays 23.3% tax, but grossing it down, it comes to 18.89% tax. So the overall tax which is paid is 18.89% against sale of shares, where you end up paying around 23.5% tax. Right? So it's cheaper that way. However, here you get the benefit of Section 54F mainly. You get the benefit of 2001 valuation. Right? If it's a listed company, provisions, which is 55(2)(a)(c) and 112(a). So you get all the benefits for sale of shares which you don't get in buyback. Right? So there are pros and cons of both the strategies. But buyback versus long-term capital gains, possibly long-term capital gains would be better. But buyback versus dividend, certainly buyback will be better. Because in dividend, there is no exemption, there is no deduction that you get. Right? There is some deduction in case you have actually, let's say, taken loan for earning the dividend. That benefit is there, but that benefit is not a significant benefit. Right? So this is one of the very simple and interesting strategies that can be used. Okay. Any questions till now? Let me have a look at it. Okay. Any questions, or you want me to continue? Feel free to ask any questions. So generally company pays tax on dividend, then why it is taxed again on shareholders' hands? The company doesn't pay tax on dividend. I don't know why did you mention company. For company, earlier it was DDT, dividend distribution tax, which was a tax that company used to pay and shareholders were exempt. But now the tax burden has been shifted to the shareholders. So now company doesn't pay tax, but the shareholders pay tax. Okay, I'll move on to the next bit. So this is a case of restriction on deductible expenditure. So in case of dividend, let's say the company does end up paying dividend. As we just discussed, in case of dividend, the tax is paid by the shareholder and not the company. Right? So shareholders also get deduction on the expenditure that they've incurred to earn dividend. This expenditure can be, let's say, expenditure on loan which is used to make investment, right? You use loan, you make investment using the loan, you pay interest on the loan. This interest is deductible, right? That's a straightforward way of using deductible expenditure. However, there's a section 57 that prohibits using deductible expenditure to the extent of 20% of the dividend received. Right? This is a new provision. It's a provision full of loopholes. So I tell you a few loopholes which are there. If the dividend is zero, in that case, you can't say that your expenses that you can deduct is zero. If the dividend is zero, you can claim 100% deduction, right? Because it says the restriction is 20% of the dividend received. If the dividend received is not there, this section itself is inapplicable, right? So that's one of the loopholes. Second loophole is that doesn't allow any other deduction of expenses, but it allows set off. It doesn't talk anything about set off or carried forward losses, right? So as we mentioned, let's say you have taken a loan of 1,000 crores and you have made investment of 1,000 crores in let's say Wipro or Infosys. You have made this investment in an unlisted company of this group, right? Or let's say you have just made investment in Twitter. Let's assume that Twitter is an Indian company and you made investment in Twitter. Twitter doesn't declare any loan for the next 5 years, any dividend for the next 5 years. And you are paying interest on this loan. You have taken 1,000 crores, you are paying interest of 100 crores every year. 5 years pay, so 1,000 crores, 100 crores every year, 500 crores, you have accumulated losses, right? Next year it declares next year, let's say it declares dividend of 100 crores. So you can claim deduction of only 20 crores, right? But you still have 500 crores of unabsorbed expenses. So you can use this 500 crores to set off against your income in the 6th year, right? Because this section doesn't talk about. So these are the loopholes which are there in case of the section 57, which restricts the deduction to 20% of the dividend received, right? A lot of other loopholes are there. One of the loophole is that you can claim deduction of expenditure under section 36. If it is a loan, if it is an expenditure, so let's say if it's a case of company A and company A has a subsidiary company B, right? It's a 100% subsidiary. There's a case law of INOX. So there's a case law which supports this view, which says that in case the loan and the investment, in case the investment is made for the extension of my business. So if company A takes loan from a bank and company A invests money in company B, and company B is an extension of business of company A, in that case, this is a business investment, right? And because it's a business investment, the loan that you have taken is a loan taken for business. So therefore, this loan, the interest on the loan is deductible under section 36(1)(3), which is a section that allows you to claim deduction on the loan which is taken for a business purpose, right? So you may be prohibited from taking deduction under section 57, but you can claim deduction under section 36. I think we are nearing our 6 o'clock deadline. So I'll not take up the other topics. In case you have any questions, please let me know. Otherwise, thanks. I'm really glad for a patient listening. Right? Any question, guys? Anything you can. You should not hesitate to ask questions. Please let me know. I would rather prefer this to be a interactive session. Anything you would have heard, anything in news or any of your client where you think of situations where there can be some better ways, or you have any silly questions also is fine. Don't think that your question is silly or
Sir,
something.
I wanted to ask about demerger of Motherson Sumi that happened recently.
Sorry, I think your voice is echoing.
Sir, I wanted to ask about the recent demerger of Motherson Sumi company, listed company. It is there, na? Motherson
Right.
Sumi firing, and it's split into 2 entities.
Right.
So I wanted to ask which type of strategy they use. I wanted to ask that.
I mean, I am not aware. If you want to elaborate something, I can tell you that why they use this strategy, but I don't keep a track of these because generally these demergers are very straightforward. So a lot of demergers keep happening. So
Okay,
you
sir.
tell me anything about Motherson Sumi?
Nah, sir, I only know that they demerged, but I don't know the strategy they used.
Okay. So generally, I tell you, demerger, the most common demerger is demerger for equity. Right? That's the most common demerger. If it's a demerger for something other than equity, it's certainly going to be interesting. But you will find very less schemes which are demerger for other than equity. Right. So one of the most interesting scheme is where there's a demerger for, as we discussed, there's a demerger for preference shares, or there's a demerger for convertible instruments, or there's a demerger for cash. Right. All these sort of demergers are possible. So there's Sterlite, which went for demerger for preference shares. There's Alembic. There's Wipro. Wipro has one of the most interesting scheme because Wipro gave a bunch of options. They gave something like 5 options that I can get cash in Wipro Enterprise. Wipro, by the way, Wipro Limited is a listed entity. Wipro Enterprise is a unlisted entity. Wipro Limited got demerged to Wipro Enterprise. So it was a listed to unlisted company scheme. Right. So what they did is they gave a bunch of options. Option was that one option was that we will simply give you equity shares of Wipro Enterprise. Right. Straightforward. Second, we'll give you redeemable preference shares of Wipro Enterprise. Third, we'll give you shares of Wipro Enterprise, but then immediately the shareholders will buy, the promoters will buy. So it was a demerger for cash sort of a situation. Very interestingly, they also gave an option of getting Wipro Enterprise shares, and then that will swap with Wipro Limited shares. So in a demerger, I'm actually getting more shares of the listed entity. Right? So these were the options which was given by Wipro. Alembic did a very interesting scheme where what they did is that Alembic Limited is a Indian listed entity, and then there was Shreno, which was a unlisted entity owned by the promoters. So Alembic demerged one of its undertaking to Shreno, which was an existing company, and Shreno simply issued redeemable preferences to all the shareholders of Alembic. So what happened is that Alembic was anyways owned by the promoters, right? 100% owned by the. So now, let's say same engineering goods division, if it gets transferred from Alembic to Shreno, earlier in Alembic, they cannot hold more than 75% shares. But now in Shreno, they can actually hold 100% shares. So this can be a strategy for acquiring 100% control over a undertaking for a listed entity. There's an interesting scheme of FAG as well, Scheffler Group, where what happened is that FAG is a flagship listed entity owned by German company. Right? So FAG is a listed entity. There are 2 more companies in the group, INA, Luke. Right? There's INA, there's Luke. 2 unlisted companies, 1 listed entity, and what their stake in the listed entity was something like 65%. Right? So what they did is that they merged these 2 unlisted companies in the listed entity. Obviously, one advantage is that you go for an automatic listing. One other advantage is that in case you can basically take the benefit of the public to increase your stake in FAG. So through this, what happened is that there's a valuation which is attributed to the unlisted entities, right? And if the valuation is very high, you will actually end up getting much more stake in the promoters would end up getting much more stake in the right? There may be some issues with this. Some groups may even try to take undue advantage of this. So one of the way of taking undue advantage, which is something I don't know whether Scheffler has done this or not, but these are some of the possibilities where a promoter can actually take undue advantage, right? And there are recourses to ensure that these undue advantages are not taken, but it happens practically. And that is that, let's say the listed company will be valued at a much lower valuation than the unlisted entities. Right? So the unlisted entities will be valued at, let's say, 20x of EBITDA, and the listed entity will be valued at either the market cap or 10x. Right? And if the shareholders would not probably look at the scheme and all and approve, in that case, if the scheme goes ahead, the promoters end up getting higher stake in the listed entity. So again, the emphasis is that as a public shareholder, it is very important to look at the way the valuation is taking place before giving the approval. And for listed entity promoters, a lot of options are there. Even when they do a fair valuation, the advantage is that they can consolidate 3 entities in one and get higher stake in the main entity. Okay.
Sir, instead of this, can we go for the initial public offering through investment banking?
Yeah, IPO is certainly there. So IPO, you can certainly do IPO. It's just that IPO is a very lengthy process. So these are some of the strategies that you can use to go for a backdoor listing. It's known as a backdoor listing. It's permissible by SEBI. This is what Adani has been using again and again. So I'm just saying that this is a strategy. IPO is certainly there. You can always go for an IPO. There's no problem in going for an IPO. Right? It's just that, let's say in this case, FAG, you have FAG and then you have INA loop. You can actually decide that INA also goes for an IPO. Right? In IPO, what happens is market generally prefer big companies. So small companies would not get that much of a appreciation in the stock price, right? So it is a good idea to consolidate. And second, when you have stake of, let's say 50-60% in a listed entity, but you decide to merge the other unlisted entity and your stake can increase to 75%. So it would be better to get much higher stake of 75% than having a lower stake. Let's say this was a case of 50 to 75, but there may be a case where the promoter stake would be as low as 10%, 15%, 20%, right? So it's not a controlling stake. So through merger, you can actually get a controlling stake. So these are the strategies that can be used. IPO is certainly there.
Thank you, sir.
Yeah. In PhonePe case of flipping into Indian, how did so so extremely good question. In PhonePe's case, there's has been done. So when I talk about, as you know, again, it's an Indian company. It went for a overseas headquartered company, Singapore, right? But this was not a case of flipping the structure. This was so yes, it was a case of flipping the structure, but it was not externalization, which is what they did earlier. It was a case of internalization. So I know the team which is working for PhonePe, right? I have talked to that team, and the reason of flipping back to India is because they want to look at Indian. So they are looking at Indian listing, right? Because you would know that Indian companies have been listed at a very premium rates, right? We know we have Paytm, we have Nykaa, etc. So the IPO is very lucrative in India. So that's why there are companies going for Indian listing. Right? The way they did it, the way they structured this internalization in case of PhonePe was where there was a swap of shares involved. Right? So swap of shares by itself is a taxable transaction. So because of that, there were a lot of complications in that because there were Chinese investors also, and you would know that Chinese investors are now banned from FDI in India, right? So because of that, there were some complications, and they were not able to structure it as a tax-free transaction. So that's the reason. Of course, I don't know the nitty-gritties of the deal, right? But it was, from what I understand, it was not a tax-free transaction because Singapore doesn't allow amalgamation to a foreign company. Otherwise, the structure would have been very simple, that Singapore can simply merge with an Indian company. The Singapore company of PhonePe can simply merge with an Indian company. But because Singapore doesn't actually allow merger with a overseas company, therefore, in PhonePe, it was not possible to do a tax-free transaction. One of the strategies to counter this can be where instead of looking at a merger, what happens is that in case of such merger, PhonePe Singapore gets merged with PhonePe India. Right? That's a simple way of merging. And in India, because it's an inbound transaction, any merger with a company where the resulting entity is India is tax-free. Right? Under 2(1)(b), it's tax-free. But if the country doesn't allow an outbound merger because Singapore has to allow outbound merger. One of the strategy that can be used is do a amalgamation transaction in India and do a winding up process in Singapore. So this way you can actually carry out a merger process. PhonePe did not do that, but I'm just saying this is one of the way in which you can get over the outbound merger restriction. Okay, I think great. So thanks a lot for patient listening. Again, if you have any questions, you can reach out to me on my, so I'll also leave my contact details. So you can reach out to me on, I'll just share my contact details. Or Arpan, you would share it or you want me to share it in the chat?
Sir, we will share with the participants.
Okay, great, fine. Great. So thanks, Arpan. Thanks, Vikasa team. Thanks. Thank you, participants, for such a patient listening and for making this interactive. You want me to suggest other readings? So the thing with M&A is that unfortunately there are no readings. So you would not find books which are published for these loopholes. The best way would be to read some sections which are relevant. So if there's any way for me to share, I'll share it. I'll share it through Arpan that it's a good idea to look at a few sections in income tax, few relevant provisions for FEMA, few relevant provisions for Companies Act, because ultimately it's just that if you have all these knowledge, it will be very easy to navigate through transactions. Right? Nobody will publish in a book that instead of dividend go for buyback, right? Because the obvious thing is that if the revenue department is aware of this strategy, there is a possibility that they will simply amend the tax. So it's like a cat and mouse chase. You try to. So I'll share the sections. Certainly, I certainly share the sections. Right, Arpan, you will be able to share the sections, right? I'll share it with you and you can with the rest of the people, right?
Yes, sir.
Okay, great. Right, so we'll be sharing the sections, so you should not worry about that. I'll also share my, so Arpan will share my contact details and email ID. Please feel free to reach out to me. Yeah, I think that's it from my side.
Thank you, sir.
Okay, thanks a lot.
Thank you,
Thanks.
sir.
Thanks, Vandana. Thanks, thanks, Arpan. Thanks, everyone.